Welcome to the InterMarket Analysis Update. This is a weekly update that I do that is supposed to supplement the daily video updates. I mainly use daily charts to show you what's currently happening as we look at a cross section of different markets and see how they're interacting with each other. You can also use this with the weekly video that I post, but if you want to get a day-to-day more of a comparison, it's probably best to use this together with the daily video update, especially the full length version. So this is for October 10th, 2022. So we'll go in and see how things look as of this coming Monday. First thing that we look at is S&P valuation. Are we expensive in the S&P? Are we just about right? Are we considered inexpensive? Well, let's go in and look at that. We're dropping down below the PE ratio of 20, and that's a static number that is used to look back. That's one problem with this, is that we use trailing 12 months earnings, things that have already happened, but we can still look at this from a historical perspective to see where was the market at other times. And I go all the way back to 1980 with this chart, so you can get some historical perspective. The red line, that means that we're at a PE ratio of 20, and that is considered expensive. If we drop down to the blue line, that's a PE ratio of 15. That's considered fairly valued. And if we drop all the way down to 10, that is considered inexpensive or cheap on a valuation basis. Well, right now we've dropped below the expensive level, and we were at this above the PE ratio of 20 for a long time. And this can go on for numerous years before it finally comes back in line. But right now we're below the PE ratio of 20, but we haven't come all the way down to the PE ratio of 15. The only problem with this is for these valuations to come back in line, you need to see usually prices drop and earnings go up. Well, that tends to not happen. Earnings go down, stocks go down. Earnings go up, stocks go up. So the fact that we're seeing a lot of our earnings being revised looking forward from here and being changed into some of these reports, that's one reason why we're seeing this decline. We're also seeing it because there's pressure on the S&P 500 right now, as there are on all stocks and all asset classes currently. So that's why this has been dropping. Down at the bottom, this is just a measure between the S&P price and the red line. And currently we've dropped below that to give you more of an indication of where we're at. This is another historical chart looking at the same thing, but it's also annotated with different major events that have happened going back to 1980. Now, a lot of times when I do these videos, I show this thing called possible positive scenarios. Well, we're going down, so we're not positive. Now, some of these scenarios are setting up, and some of them are generating some new signals. I'm not going to deal with those in this video. I do update them in the daily video update, the full length version. So if you want to keep up with what's happening with these, please look at those. These are some really powerful things that we usually hit at a low to establish a base, and then we are able to launch up out of that. And I have a lot of different areas that I look at with those. And as we're going down, we're setting up some more of these bases, so to speak, that at some point could lend themselves to the market turning around and becoming more positive. But since we're going down, we don't really pay attention to them as much right now. We watch them every day, but we're not using them as part of our everyday analysis. First, we look at growth and value. Here's just the growth index, and it continues to be in a downtrend. The red line is the 200-day moving average. The blue line is the 50-period moving average, and we are in a downtrend overall. We're also seeing a downtrend with growth, but it's holding up a little better, and that's why value is outperforming growth when you compare them with each other. This top chart looks at growth versus value, and this just shows how growth has been underperforming, where the bottom chart is value versus growth, where value, even though it's been getting hit too, it is outperforming growth. In a good, solid market environment, We want to see growth outperforming value. That's where our capital gains come from. That's when stock prices really go up. That's when indexes really go up. When we're going down or sideways or in a lot of trouble, that's when the market focuses more in the value area. Here's another way of looking at that same thing, looking at a growth index and a ratio of a value index. And it just shows that we have been in a downtrend compared to growth versus value. We tried to recover up out of that, but we're continuing to fall back. And even though we're in a downtrend, we're seeing these moving averages coming kind of closer together now. If we can get a little bit of support and have growth outperform value, we might end up seeing a golden cross here, which could be positive for the market. This next chart is just an inverse of that same chart, except now we're putting value first, showing how it has been outperforming, showed some weakness, and it's still looking pretty strong. But see how these moving averages are getting rather close to each other when you compare the value to growth ratio. Here's another look using ETFs, seeing pretty much the same thing. So I do duplicate what I'm looking at just because we might get some different insight at looking at this. This just shows how growth has really been underperforming value, but we might be getting ready to see a cross in the near future. This is the inverse of that same chart, how value had been underperforming, but in 2022, it's been really outperforming, but pulling back and now still doing better, but we might see a moving average cross here. There's another look using an index where it just shows that growth has continued to underperform overall. Looking at some other markets, these are the 30 biggest software companies. They're still in a downtrend. We might be setting up some kind of a base here. See where we set a low, then a little bit lower low. We haven't breached that low yet. Could this be a real faint head and shoulders bottom? Possibly. But we're going to need to see price really go up, see a golden cross for this to turn positive. In the meantime, this still remains negative. This is a monthly chart, so I'm actually going beyond just the daily chart, where this is the CRB index. This measures inflation and different commodities. And even though it's shown some recent weakness, it's still in an overall uptrend. Well, Martin Pring, who developed this, he came up with some inflationary stocks, and then we take a ratio against some deflationary stocks. And overall, we're still in more of a deflationary period. So this chart is suggesting that inflation is not really a problem, but this is a subjectively created chart. So we just want to keep an eye on this over the long term. Another thing that we look at is a thing called the Balter Dry Index. How much does it cost to ship things from point A to point B? When the costs are more, we tend to see this really start to go up. Those shipping costs are then fed over into the ultimate prices that are paid, and that can be inflationary. We're still in a downtrend, but we have been really bouncing up as of late. We also look at the CRB in and of itself. This is a daily chart showing that we're in an uptrend. We saw some weakness, and we actually fell below the 200-day moving average, and we might even be getting ready for a death cross here. The dollar has really been doing well lately, and a lot of these commodities are dollar denominated. And when the dollar is going up, that really hurts the price of some of these commodities. So this could suggest that possibly inflation is slowing down, but a lot of this is also due to strength in the dollar. We'll look at corn, where it is going back up after having a decline, but it's kind of going sideways recently here. Here's aluminum, which really spiked to the upside. It fell all the way down and is now starting to bounce back a bit. Heating oil, which continues to be pretty high right now. And as the seasons change and things get a little bit colder, there'll be a lot more demand for heating oil. Gas, this is something that we all feel every day. It really spiked up a few months ago. Well, then we had the strategic oil reserves released, which are supposed to be used for emergency purposes. I'm not sure if a political election is considered an emergency, but that just flooded the US and some other countries too with some gas. And since there's more gas out there, that has really brought some prices down. But lately, what we're seeing is gas prices are starting to go back up. And OPEC came out with an announcement this past week saying that they're going to do 200 million barrels less per day. And that's one of the reasons why things are spiking back up. And so this could be bad timing because this is happening right before the election, since the reason for gas coming down was a political event. So we'll have to see. Are they going to be able to get this more under control? Natural gas also had really spiked up, but continues to come down, but it's still pretty high overall. Oil, which had fallen below 80, is now going back up. This kind of goes hand in hand with gas prices. And then wheat, something that we need for bread and all the yummy things that we eat, it had come down, but is starting to go back up, but it's not as high as it had been. Another thing we look at is fertilizer. This is a Bloomberg index that I found where it shows that fertilizer prices are still high. They're off their high, but they're still pretty high overall. This can also be inflationary because this is what is needed to produce things. And if it costs the farmers and the different companies that produce food more to produce that, well, they ultimately have to pass those costs on to us. And that is inflationary. Lumber is still in a pretty solid overall downtrend, even though it has been bouncing up a little bit lately. We really saw this go up during the whole COVID lockdowns because people were doing all their little home projects and everything. Well, since 22 started, it's really been coming down overall. Here's the dollar. We're still in a pretty solid uptrend. This is a daily chart where we really spiked up. We came back down, and that was giving some support to stocks. Well, now it's been going back up, which has been pressuring stocks over Thursday and Friday, specifically this past week. And this is also one of the reasons why gold is not really going up, because the dollar is maintaining some strength. Here's the euro, which has been in a decline on the top, and here's the dollar index. This isn't just against the euro. This is an index mostly against the euro, but there's other currencies thrown into this, and it just shows how this has really been going up overall. This is taking the Japanese yen on the top and showing how it's been declining. The euro's been declining as the dollar has been advancing. Copper, another thing that we look at to see about the health of the economy, and we're kind of about at the midpoint right now. We had been going up, which means, okay, they think the economy is going to be better in the future. We topped out and went sideways for a while. Then we fell when it looked like the economy was weakening. Well, we're kind of in a sideways movement right now. And this is more at a value that is more neutral currently, but it is in a downtrend overall. Another thing that we look at is the copper to gold ratio. And what's outperforming? Well, copper right now is underperforming gold. Gold's not doing all that great, but copper has been doing even worse currently. And this is a longer term look at that same chart. The black line is the copper to gold ratio. It has been declining. And then we plot on here a 2-year yield. And again, as I say, every time when we see this chart, they have a tendency to go in the same direction. And even though they're on different scales, they have a tendency not to get all that far apart from each other. Well, they still continue to be way far apart right now. So this is just part of the economic upheaval that we're seeing as interest rates are going up. And gold really hasn't been going up. Copper has been kind of going sideways. So it's just showing that the economy is just not all that strong right now. Gold, after coming up to its 50-day moving average, has been bouncing back below that. And everybody keeps saying, oh, this is it, man. This is the breakout. Here's the breakout. Here's the breakout, only to come back down. Now, there'll come a day when gold really does break out. But as long as the dollar is strong, that's pushing a lot of gold prices down. It's keeping them in check currently. But if we start to see some weakness in the dollar, you might start to see some price advancements with gold, specifically the ETF. And there's a lot of fundamental things going on. There's an interesting podcast that I listened to over the weekend that talks about some of the fundamentals between gold and silver and why are they just not going any higher? And it really went into a lot of detail about that. If you're interested in that, let me know. I can easily send you the link. It's a podcast I listen to every week, but they had a guest on there that really knew what they were talking about with precious metals and explained it in a way that was kind of easier to understand than just it should be going up and it's not, or it's going down, but it should stabilize at some point. Here's silver, which also is in an overall downtrend. Currently, looking at some indexes, here's the CRB index, the inflation gauge compared to the S&P 500, and the CRB continues to outperform the S&P 500. And this is the inverse of that same chart where the S&P is underperforming the CRB index. This is the Nasdaq 100, which focuses on growth compared to the S&P 500. The Nasdaq 100 continues to underperform. This red line's the 200-day moving average. The blue line is the 50. Looking at some other stock areas, these are mega cap growth. These are the big boys, the Meta, Google, Apple, the big giant tech companies mostly. And this is where, when we're in a more positive economic environment with a lot of growth going on, that's why we really see these run up. Well, we've seen a lot of trouble in 2022, and they've been falling down, but they're still maintaining this, what could be support, but we're seeing we did have a death cross, and we're still in a downtrend overall. So we want to see, are we going to get some support from this level? The S&P 100, which are the biggest companies in the S&P 500, continue to underperform the rest of the S&P 500. Small caps, they've actually shown a little bit of life recently, and they're outperforming the rest of the S&P just slightly right now. Low volatility stocks. These are stocks that folks get into when the market's running into trouble and are more value type plays. They continue to be in a downtrend and have seen some recent weakness. And we just had a recent death cross as well. And then this is the S&P, the low volatility stocks compared to the rest of the S&P, where even though they've seen some recent weakness, they still continue to be in an overall uptrend. Here's the Dow, the transports and the utilities taken together as one measurement. They continue to be in a downtrend overall. Here's some Dow theory, where we did make a new 52-week low numerous times with the Dow and with the transports. But look at how utilities have really been declining. They were holding up and doing quite well just a week or two ago. Now they're starting to really lead things more to the downside. Now, I understand that not everybody uses utilities as part of Dow theory analysis, but I like to have all three of them together. FANG stocks, the Facebook, Amazon, Apple, Netflix, Google. These are another look at the really big companies. Most of them are, in fact, all of them are tech, where they're showing some weakness. They're in a downtrend, but so far the support right down here continues to hold. If we break down below this, then that could suggest that things are going to get worse. ARC, which also tends to be holding to support right now, but is still in an overall downtrend, and it's just gotten hammered in 2022. Bonds continue to fall based on price, and here's our world bond index, which also continues to fall based on price. A monthly chart of the stock to bond ratio shows that stocks have been struggling, bonds have been struggling, but as of right now, stocks have actually been outperforming bonds, which is strange because when we get in really tense environments, a lot of uncertainty, the market's going down, people have a tendency to switch from the stock market over to the bond market. Well, it's doing even worse in the bond market than stocks have been performing. There's been no safe place to go in 2022 unless you just get rid of everything and hang on to cash. And maybe we're able to get into energy at some point and ride that wave. This is the bond to stock ratio, which shows that it has been underperforming. And with this is little shorter maturities, where the other ratio is longer maturities. We're seeing what could be a death cross here. Then stocks and bonds are having a pretty strong tendency to go in the same direction. The closer we get up to one, that would be a one-to-one relationship in the same direction. When we get to -1, that means a one-to-one relationship in the opposite direction of each other. If one's going up, the other one's going down. And stocks and bonds have are having a tendency to go in the same direction currently. The corporate bond index also showing continued weakness based on price. This is the S&P 500 to the rise in interest rates. Well, interest rates have really been going up, so this shows that the S&P has been underperforming. Junk bonds, which also have a tendency to follow the market, they are starting to see some weakness, and they actually broke below this support, and they continue to be in an overall downtrend. Here's a ratio between junk bonds, risky bonds, and treasury bonds, not risky bonds. Even though junk bonds have been getting hit, they still continue to outperform treasury bonds, which are considered very safe. Here's a daily chart of the yields, and it's just amazing now where the blue line, that's the 2-year yield. That's giving you the best yield right now, but this just shows the overall tendency of interest rates has been higher. This is an international look where they had been having a lot of trouble in the UK. Well, the UK interest rates are actually going above US rates, which is something we haven't seen in quite a while. Germany is also raising their rates. Japan is keeping their rates pretty much flat right now. They're having a lot of problems there, but they're a little different than what the rest of the world is facing currently. This is something that could be positive. When the ratio between the S&P and utilities, when this is going up, that tends to really support the S&P 500. When this is going down, that puts pressure on the S&P 500. We came down, possibly set some kind of a low here, and even with the down days that we've been seeing, this has been bouncing up. So we want to keep an eye on that. It's not that the S&P has been doing really well, it's just utilities have been just getting hammered lately. Staples, also something that folks tend to get into when they're more defensive. We're starting to see a real weakness here, and we've dropped below support currently, and we're beginning to start a downtrend here. Energy, which has been really well, even though it had some recent weakness late summer, still continues to be in an uptrend, especially when you compare it to the S&P 500. Technology, a big part of growth, a big part of the economy, a big part of the indexes, continues to be in a downtrend. The SOX index, which measures semiconductors, which is a huge part of the growth sector, continues to be in a downtrend as well. Technology to the S&P just shows how technology has even been underperforming the rest of the S&P 500. Some other areas to look at, here's growth, which we've really struggled with because prices are going down, and bonds, which have really struggled. Well, they're pretty much going sideways here with a slight advantage to growth on a trend basis, but seeing some recent weakness on a ratio basis. Here's the 10-year. As interest rates have been going up, the tech sector has been really underperforming. And here's just the inverse of that, showing how the tech sector has really been underperforming the rise in interest rates. Discretionary, which was starting to show some hope here back in September, has now fallen below this moving average and is really underperforming staples. And here's staples, which also are having some problems, but they're holding up better than discretionary. Currently, energy to tech, energy has been really outperforming. Tech has been underperforming, and that's why this chart is going up. Then gold, which a lot of people get into, even though gold really hasn't been doing all that well, it's been doing better than the S&P as of late. And here's gold to the dollar. The dollar's really been holding up, so that's why this ratio continues to decline. High leverage loans. These are riskier loans that people sometimes take on, and they're actually holding up a little better. They came down, tested recent support right here, and bounced back up slightly. That could be potentially positive. That means that these riskier loans, people are able to make those payments, and the companies that give them these loans are still showing some positive earnings. Here's an intermarket analysis chart. The red is oil. Now, for a while, it actually was underperforming the dollar, but now it's been bouncing back. And then we have gold, stocks, and bonds, which continue to be negative going back to the beginning of the year. Looking at some indexes, when you take the Amex, the Nasdaq, and the NYSE, you look at their highs minus their lows. This is studying their internal strength. And this is what we want to see. If the market's going up, we want to see this ratio, or this moving average really start to go up. Well, we're still below zero right now after giving an extreme negative reading. Sometimes when we hit a real negative extreme, that can offer some support to the S&P. We're just not seeing that based on price yet. Small caps, they did end up closing down below the pivot point right now, and they continue to be in a downtrend. The mid caps also fell below the pivot and are in a downtrend. The Dow below the pivot, downtrend. Nasdaq below the pivot, downtrend, broken record time. Nasdaq 100, but see how it's holding up a little bit better here. Now, this could all change on Monday. The Wilshire also is showing recent weakness. All stocks continue to be in a downtrend overall. Emerging markets. Sometimes people get out of a US based portfolio and look to deploy things internationally. Well, that really hasn't helped at all. China continues to be in a downtrend, but is trying to turn up, as are the emerging markets. Europe trying to turn up a little bit. Japan trying to turn up. So we're still in downtrends internationally, but you see these are starting to turn up ever so slightly. Could we get some kind of push to the upside? We're into a more seasonally favorable time for the stock market. We do have an election coming up. Are we going to see, now that we got through September, is there the potential of seeing prices actually move higher? We see a lot of evidence that that could happen, except we're not seeing that based on price, which is the ultimate evidence. Then Bitcoin still tends to flounder a little bit above, a little bit below 20,000. Looking at some correlations, the S&P to the dollar still having a tendency to go in opposite directions. S&P to oil also, even though this is weakening, having a slight tendency to go in the same direction. S&P to the 10-year also, it's not as strong of a relationship, but they're having a tendency to go in opposite directions. Tech, which is growth, to the 10-year, which are interest rates, this is getting back up more to the neutral area right now. The S&P to the 2-year also seeing a weakening of this relationship, but having a tendency to go in opposite directions. All right, so if you've watched more than one or two of these videos, this has not changed. Energy, the CRB index, and interest rates continue to be in uptrends overall. And then we have the whole list of the things that are negative, which it's really hard to find a good area to experience growth right now. And unless you're in the dollar, but you're not really earning anything, if you're in your money market account or some kind of savings account, you're getting virtually nothing through that. Plus, you're taxed on that. And so it's really been challenging to find some kind of good, consistent returns unless you have been able to time the energy market much better. So thank you. I hope you find this helpful. Please feel free to check out the full-length video. I do post videos every day, both a full-length video and a daily brief. And there's also a weekly video that you're more than welcome to check out.